You want to protect your money, but keeping every cent perfectly safe is the exact mechanism by which that money loses its power. The opportunity to grow your wealth is visible on the screen, yet a specific hesitation blocks you: the sudden, visceral fear of seeing that principal balance drop. This risk avoidance mindset prioritizes the immediate feeling of comfort over the actual pursuit of opportunity. Your brain is optimizing for psychological safety rather than financial growth. This hesitation comes from a biological glitch in the human brain. It's a survival instinct that can be overridden once you recognize how it miscalculates modern data. Hoarding cash mimics the sensation of preservation. In practice, it is a state of hesitation that stops your capital from performing its primary function. Psychologists call this biological glitch loss aversion. It is an evolutionary leftover that triggers a defensive response whenever your resources are threatened. This chart measures perceived results. The top bar shows the emotional reward of a financial gain. The bottom bar shows the pain of a loss is twice as severe. Overestimating this pain, the brain rejects high probability opportunities, defaulting to doing nothing to avoid the spike. This manifests as overthinking a small index fund purchase or allowing investable savings to sit in a zero-yield account for years. The brain interprets this lack of movement as a state of safety. Avoiding the temporary sting of a market fluctuation leads to a future where your savings lack the growth needed to maintain your standard of living. Opting out of market volatility replaces a visible risk with a hidden mathematical certainty. This graph shows inflationary decay. The top line is a static cash balance, but the line below shows purchasing power sloping downward. Compare this to an investment. This volatile line dips frequently, but over 10 years it trends upward, finishing significantly higher. Attempting to achieve zero risk results in a slow, predictable erosion of wealth. Idle money misses the compounding cycles required to keep pace with an evolving economy. Since cash loses its utility every single day it remains uninvested, doing nothing becomes a very expensive decision. Moving forward requires a shift to controlled risk. This is a framework designed to manage uncertainty rather than run from it. First, allocate small amounts of capital. These minor positions build your tolerance for price movements without overwhelming your internal alarm system. Second, use research to remove the unknown. When you understand the historical behavior of an asset, it feels less like a gamble and more like a calculated move. Third, extend your timeline. Focus exclusively on long-term compounding data rather than the noise of daily or weekly price changes. A long-term view turns a market dip into a minor data point on a much larger upward curve. Fourth, accept that temporary losses are a structural part of any successful financial trajectory. Every successful person experiences losses. Avoiding loss completely is the exact same thing as avoiding progress. Wealth is built by those who learn to manage these periods of friction to keep their progress moving upward. This fear of loss is an instinctual baseline operating exactly as it was designed to. Wealth generation begins the moment you bridge the gap between that biological demand for safety and the execution of a calculated plan. To see the mechanics behind these market movements and master your own financial growth, subscribe to the channel now, because while you wait for the perfect moment of safety, inflation is already reducing the value of your savings. Which brings us back to the start. You want to invest.